Welcome to my channel. So just like I mentioned in my previous video on liquidity in Forex, you're going to be looking at trendline liquidity as one of the liquidity types you would be seeing in the Forex market. So I'm going to talk about how some of these trend lines induce traders to take wrong positions where they get their stops hit, and after that I'm going to show you how you can actually avoid being taken out by the market as a result of this trend line liquidity. So make sure you watch this video till the end to actually understand this concept. This is UCFX. Welcome back to my channel. This channel is all about helping Forex traders get acquainted with the necessary information and knowledge on how to become profitable in the Forex market. So if this is you interested in content like this, subscribe to this channel and turn on the bell notification icon to be notified whenever we upload new videos. And don't forget to drop in the comment section any topics that you would like us to make videos on. Make use of this opportunity and get connected to this channel while we help you on your trading journey. So without further ado, let's get into what we have for today. So trend line liquidity. After this, we will look at the buy side and sell side liquidity, as well as liquidity in form of equal highs and equal lows. So make sure you are subscribed to this channel to see these videos whenever we upload them. Yes, trend line liquidity. So how can this trend line liquidity induce traders on taking wrong positions? Let's say the market is actually in a downtrend. Then you're like, oh, we have a trend line there. Then you draw a trend line, take from the first point to the second point. Then you take your Fibonacci for a little confluence. You take it from the lows to the highs, waiting for that perfect entry to actually enter at the touch of this trend line. Then what happens after taking your trades? Let's say price comes back to this trend line. You take your entry. You take your entry right here, put your stop loss, and then target let's say the next lows or below. Then what happens next? You got a little tiny rejection. Then after that, boom, the market takes you out. And after that, market still goes your way. And then you are like, oh, my broker is against me, or the market is against me. We actually need to understand this. Yeah. Whenever you're making money from the market, someone else somewhere is losing money. And whenever you are losing money, someone else somewhere is making money. So just like before you can be able to sell in the Forex market, even actually in any market, you need a buyer. Before you can be able to buy, you need a seller. So from the basic knowledge of Forex, if everyone is actually selling off of from this trend line, then who is buying and ready to lose? So this brings us to the Forex liquidity concepts. So we need to understand the motive behind price movement in specific ways. We need to follow and learn and understand the Forex big players' blueprint. And these big players are the big institutions and the big banks, with the likes of the JP Morgan Chase and the HSBC. So we are actually we are trading against these people, and they have algorithm that is working in their favor. So and they are not going to make it easy for anyone. So we need to step up from basic knowledge of trading to understanding price action. So these people are the one that cause this liquidity by creating all these trend lines and the likes. So they are not after one person, but after a large number of traders. So who don't actually understand some of these things. So liquidity is actually a fuel of the market. That is, liquidity is what moves the Forex market. So I'm going to share this liquidity concept with you to actually enhance your trading. So we're going to be soon we're going to be going to the chart to actually explain this so that you can actually understand better. So this would be from a smart money perspective. So we are going to use this trend line to illustrate this liquidity. Yes, so we can actually use this trend line in two main ways, and one of them is as targets. So let's say we have a market going to the upside, and then we have this area as a point of interest, looking to take our trades, and then the market starts trending lower, entering our point of interest, and then we have this trend line here. And after that, the trend line gets taken out. Boom, the trend line gets taken out, and then why? Because most traders or less informed traders are actually selling off from this trend line. So this area we actually mark that as our point of interest. So, and these traders that actually took these sales have their stop loss behind these highs. So we're going to be using those highs as our target of taking profits. And then the second way that we're going to be using the trend line is as our confluence. Yeah, you heard me right. Yeah, I know probably say that I've actually said that the trend line is a point of liquidity, but no, we can actually use it to know where to take our entries from. So let me actually explain that. So let's say the market is an uptrend. Yes. So, and then we have our trend line. So what next? We have our trend line. So what next? We actually need to wait for price to take out this trend line, and we have our demand area or point of interest inside the zone. Yeah. So what price will basically do is take out this trend line, and after that, it will retest the trend line. Then most traders will as well start selling the market based on the test of trend line strategy or whatever. Then after that, we have a little pullback, and this is where we actually want to get interested. This is actually where we want to buy this market from. Then what next? All the traders are actually taking out. The market continues in an uptrend. So and hence this trend line is actually manipulated. So we actually used it as a confluence, giving us a directional bias that the market is trying to take. So the market actually does two things, which is seek and destroy, and then balances. So let's learn how to actually trade this using the real chart to actually avoid this liquidity. Yeah. So here we are on the real chart. This is NZD USD. Yeah. So you actually agree with me that we have this trend line that will be following this pattern. So as you can see, we had our first touch, our second touch, then we had this third touch. Then after the third touch, price reversed, taking out the stops of those that actually bought inside this area. Then after that, we had a slight retest of this trend line. Then most traders again started selling off from this trend line. As you can see, we have this sharp bearish candle, which is very, 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 very destructive because it's actually an inducement candle, right? So then you take your trades, you pull your stop loss, you take your trades from this area, looking at this inducement candle, put your stop loss, then place your take profit, and then boom, the market takes you out with this bullish movement. So if you actually trade the smart money concept, you will actually see this market in another way. So just like I've been mentioning in this channel, if you have actually been following, understanding how I actually teach this smart money concept, how I actually take my trades and all those, so you actually know how you would have taken this trade. Looking at this from a way of someone that actually understands this liquidity concept, you would agree with me that we have our order block inside this area. We had our order block inside this area. Then and then what? We had break of structure. Then, so after we had our order block, we need to wait for a break of structure. Then we had our break of structure. Then we had our liquidity being taken out, which is that trend line. See, so we had liquidity being taken out, which is actually that trend line. So here is actually where traders got liquidated. So, and then what? As a smart money trader, you need to wait for the price. If you need to wait for price to actually come back to your order block, and then you need to go down to the lower time frame to spot a lower time frame formation, order block formation, and as well a break of structure. Just like you spotted on the H4 time frame, we had our order block, we had our break of structure. We need to do the same thing when price returns inside this area using the lower time frame. So we're going to be using the H1 time frame for this. So here on the H1 time frame, here we had our liquidity being grabbed. Here we have our H4 time frame order block. So price come back, taps into this order block, lower H4 time frame order block. Then we need to wait for another break of structure in this lower time frame. And as you can see, we had a break of structure. We had a break of structure, and then what? You need to wait for another liquidity, which is actually a retest of that trend line liquidity. This is actually the point where the trend line actually got rejected. So we have liquidity above this trend line, and we have liquidity below this trend line, because most traders will actually start taking their trades from this area and putting their stops above. So we have liquidity actually on both sides. So after that, we need to, just like I said, need to identify liquidity, just like we have identified. And so we have our liquidity here. Then what next? We need to wait for price to tap into our lower time frame order block. Deep down inside this area, we had our H1 time frame order block here. So we're going to be changing the color to white. Then we had our lower time frame order block. Price come back into our order block. So as a smart money trader or someone that actually understands these liquidity concepts, this is where we actually take our trades from. So this is where you take your buys. Then your stop loss is basically below this order block, this lower time frame order block. So as you can see, we have about 25 pips stop loss, and just like I said, we use the trend line as confirmations, as our confluences. This is a typical example of the sketch I actually showed you. So we need to understand the movement, then wait for the trend lines to be taken out. Just like we saw here, the trend line was actually taken out, and then we had the retest of the trend line come back, giving us a nice pullback. This is the area we actually took our entries from. And as well, we have another trend line. Just like I said, we use the trend line as targets. So we have stop loss above these areas, because most traders would start taking another trades once price comes back into this trend line. Just like previous traders have their stops above this area. So we actually target this area as a take profit. So we use the trend line as targets, just like I said, because the stops are behind the highs of those that are actually shorting the market. So we have our take profit above these highs, and just like that. So looking at the higher time frame, you could actually target even way higher, looking at the structure that the higher time frame is actually given. And then using our higher time frame, we can actually target way higher. Just like we saw here, this is our last high. So most traders will keep on having their stops behind these highs. So this is actually a nice trade with a risk to reward ratio of almost 1.5. So who wouldn't actually want to take this kind of trades? So this is basically what you get if you can actually understand this liquidity concepts. So I'm going to be making a one more example before I call it a video or a day, whatever. Yeah, so if you actually wanted to understand or learn more how to trade and avoid being liquidated. You basically want to learn more on these forex liquidity concepts, I suggest you go into my channel, uh, check out the videos I made on other blogs, how to trade other blogs, or just basically go and learn the smart money concept video I made from episode 1 to episode 5. I actually explained it from a kind of basic level to advanced level. So I'll be placing the link to the videos in the description below. So let's use this USD JPY example to wrap things up. Yeah. So looking at this chart, we have our first point here, then we have our second point, and then what? Boom. Third point gets taken out. So this is actually where all this liquidity stuff lies. So assuming you actually understand this liquidity, looking to your left, you would actually spot a break of structure, just like I've already marked. Let's go to the H4 time frame. So here on the H4 time frame, we had this break of structure. So we need to consider this range. So looking at this range from this point to this point, we have this other block here. So marking out the other block, we still thread the same stuff just like I explained on the previous video. So let's take it out this trend line. So looking at this other block, you take your Fibonacci, check where the price is at. Remember, just like I normally explain in my videos, that's why I actually said that you should go and check them out, because I actually explain more than I'm actually explaining here in this video now. So the videos I actually suggested that you go and watch is has more information than what I'm actually saying about this other block now. So looking at this Fibonacci tool, price came back into our discount level. Then what next? You need to go down to the lower time frame to spot your lower time frame confirmations. So we go down to the H1 time frame. So here on the H1 time frame, we still look for the same stuff. We still look for other blocks. Here we have our H1 time frame order block, and then we have our break of structure, lower time frame break of structure, and then we have our liquidity in form of equal highs. I'll be explaining this concept in my next video. So if you look on the H4 time frame, you will as well see another kind of liquidity in form of equal highs. So we have this liquidity as well in form of equal highs. Then we also had that trend line liquidity which got taken out. So basically we have two forms of liquidity in play here. But this equal highs, liquidity in form of equal highs, I'll be explaining this on my next video. So after price must have taken out this lower time frame liquidity, you need to wait for price to come into this lower time frame order block. So this is where you actually take your trades from. So you take your trades from here, then your stop loss is basically above this H1 time frame order block. So your stop loss will basically be around 30 pips. Yeah, 30 pips. And then you target the lows or the next low, which is actually somewhere here. So that will actually be giving you a 1 to 7, almost a 1 to 8 risk to reward ratio. So that's pretty cool. So understanding this market liquidity and how the market plays out would actually enhance more of your trading style. So if you actually understand, if you actually like this content that I actually made, I suggest you subscribe to this channel, and don't forget to reach out to us, commenting on any topics that you would like us to make videos on, or better still, check out our videos that we made on how to trade other blocks and other forex liquidity stuff that we made in this channel. Basically, the learn smart money concept episode that actually said that you should check out. So see you on the next video.